This visualization maps out global GDP, highlighting the estimated 2 to 5% that is laundered annually. That red portion represents up to $2 trillion in illicit capital flowing through the legitimate economy every single year. Tracing that money is rarely a matter of following a single duffel bag of cash. Today, illicit capital is moved by professional money laundering networks, or PMLNs. These networks of accountants, lawyers, and corporate agents use cross-jurisdictional legal friction to deliberately sever the paper trail. To track these assets, investigators have to reverse engineer the specific filtration phase these networks design to obscure the money's origin, a process known as layering. Understanding the exact architecture of that concealment is the only reliable method for penetrating the network and identifying the true beneficial owner of the funds. This diagram shows the three-stage laundering model.
First, placement. Illicit cash enters the financial system. Next, layering. Funds are shuffled through shell companies to hide their origin. Finally, integration. The money re-enters the economy as lawful income, converted into luxury assets. Financial investigators work this process in the exact inverse. They begin at that reservoir of clean, integrated assets and trace backward through the layering pipeline to locate the original contaminated source. One of the primary tools used in the layering phase is the shell company. These are non-traded corporations that exist almost entirely on paper. Because they often consist of nothing more than a mailing address and a registered name, they effectively shield the owner's identity from regulatory authorities. This chart maps the Sega Sammy Holdings case. Notice the purchase of Index Corporation, followed by an asset transfer. Then the original Index Corporation dissolves. A new shell company takes its exact name, breaking the paper trail and creating a clean slate. Large-scale infrastructure operations frequently employ this exact mechanic. They pay a shell company via a legitimate-looking check, and the shell company records the outflow as payments to even smaller entities, creating a circular paper trail that obscures the initial bribe. This diagram shows Method 1, moving kickbacks through multiple foreign jurisdictions. A $100,000 bribe moves from a business partner named Tom to a politician named Joe, routing through a shell company in Country 2 and into a trust account in Country 3. This second schematic illustrates Method 2, which introduces third-party intermediaries. The profits from company shares are channeled through a shell company into an anonymous Country 3 trust, which then makes direct disbursements to the offshore bank accounts of Joe's wife and son. Methods 3 and 4 escalate this complexity by utilizing professional facilitators, lawyers, accountants, and private bankers to execute rapid international wire transfers. These professionals leverage their own legitimate legal standing to bypass standard customer due diligence checks. These overlapping layers and cross-border jumps are engineered specifically to stall law enforcement. Each new jurisdiction requires separate warrants, treaties, and legal maneuvering to access the financial records. This photograph shows an aerial view of a Caribbean financial haven, jurisdictions like the Cayman Islands or Nevis. These locations offer the formation of offshore corporations that operate completely free of domestic tax and are protected by strict corporate secrecy laws.
Many launderers reinforce these shell companies with offshore trusts. Irrevocable trusts prevent the creator from altering them, putting assets legally out of reach of creditors. Discretionary trusts give the trustee power to distribute profits among different beneficiaries, making the true ownership highly fluid. The strongest asset protection trusts include a flee clause. This mechanism legally compels the trustee to immediately shift the trust's domicile to a new jurisdiction the moment it is threatened by a foreign court order or police investigation. The entire structure is a carefully calibrated legal balancing act. It separates the criminal from direct ownership, strictly satisfying the literal requirements of trust law, while ensuring they maintain effective, untraceable control over the assets. Launderers also utilize informal value transfer systems like Hawala. In this model, value is transferred across borders using a network of brokers and balanced ledgers. Because the brokers settle their dots with each other over time, no physical money ever crosses an international border during the transaction. This visualization maps a cryptocurrency peel chain. A large sum of digital assets is broken down and sent through hundreds of intermediary wallets in rapid succession. The volume and speed are designed to sever the connection between the source and final destination. Digital assets execute these transactions in seconds rather than days. But while the velocity and the technology have scaled, the mechanical objective remains exactly the same: placement and layering to hide the source. This is the U.S. Department of the Treasury, which oversees the Financial Crimes Enforcement Network, or FinCEN. In 2024, FinCEN launched a registry under the Corporate Transparency Act, requiring domestic companies to report their beneficial ownership information to unmask shell entities. However, on March 21, 2025, FinCEN issued a rule suspending this requirement for U.S. companies and citizens. The reporting mandate was narrowed to apply only to foreign entities registered to do business within a U.S. jurisdiction. With domestic registries no longer collecting this data, investigators are forced to adapt. Tracing assets now relies heavily on open-source intelligence, leaked data repositories, and advanced investigative databases. The investigation follows a strict four-step framework. Step 1 is building the network tree. Investigators map the primary subject and expand outward to identify spouses, business partners, and political allies who often act as nominee shareholders. Step 2 isolates real property holdings. Investigators scan public real estate records, tax assessments, and utility accounts to find the physical footprints left by the target at high-value properties, even if the deed is held by a shell company. Step 3 penetrates the corporate structures. Analysts cross-reference property findings against corporate registries and massive leak databases, searching for matching director names. Step 4 leverages human sources. When documents reach a dead end, investigators cultivate whistleblowers among the very service providers, accountants, lawyers, and registry agents who set up the networks. The goal is to map the exact inverse of the launderer's design. By systematically dismantling each layer of corporate secrecy, the investigator peels back the legal friction to expose the true beneficial owner hidden at the center.